In this video I have the 5 best indicator signals for you, and especially number 3 and number 5 are my absolute favorite signals. We're starting with a very simple but still yet a very effective one, is the RSI Divergence, and here you can just use any RSI. I'm using the 14 period, which is the default setting. We have a divergence when the indicator and the price action are not agreeing and they're showing opposite things. Also, you want to look for a divergence in a trending market. Divergences should only be looked for in trending markets. So here we're looking at an uptrending market, and then when the price action is making higher highs, when we connect the highs, you can see this is a higher high. The indicator, when we connect the same highs, it's giving you a lower high. This shows us that the indicator and the price action are not agreeing. Why is this happening? It is happening because there's weakness in the last trending phase. Whereas previously the market moved up very strongly, very quickly. In the last part, the market didn't move higher, obviously a lot, and that is the weakness that the indicator is picking up. So the indicator is signaling us that something is changing here in the market structure and in the trend dynamics. When it comes to trading a divergence, I would recommend that you wait for the market to break the highest low. So when we look left at the trending market that has been going on, we can identify this swing point at the highest low. When the price action is breaking this area here, it is called a break of structure, and at that point the market is starting to make lower lows. This is a very important trend shift, and it signals a change in the overall market structure. The entry in such a case would be given here. You want to look for a strong breakout candle. You can see that the market may have closed here below the low here already. However, you want to see the market breaking out with a strong breakout candle, such in this case. At the same time, you can see that the indicator keeps making lower highs. This is a great signal because the indicator is confirming that we're seeing more strength on the bearish side. Afterwards, you can see the breakout happened here. The market retested previous support. It became resistance. If you're not a breakout trader, this could have been another signal to help you get into trend following trades here with the resistance touch point. Next is a pivot point continuation. I love pivot points. I use them every single day in my trading, and I think they're a really great addition to any trader's arsenal. One thing that we can see when we activate the pivot point here, and this is the daily pivot point on the 1 hour time frame, we can see that initially the central pivot point was moving lower. From this pivot point to this one, the pivot points were moving down. This is a bearish structure. However, when this changes and suddenly the market is retesting pivot points as support, as in this case, and even here to some degree, this is a change in market structure. Previously, the market tested the pivot point as resistance here from underneath. However, when this changes, this could foreshadow a potential change. But there's even more to the pivot points, as we are about to see. I also drew the trend line and I marked the last resistance area. For a trending market, you want to see that the market is able to take out highs and also clear the trend line. This happened here. The market broke above the trend line and it cleared the resistance. This signaled the first impulsive move. Then you can also see the next pivot point was significantly higher. This is confirming the uptrend, and what you will often see that during uptrending markets, the price action stays above the pivot. Sometimes you will get a retest into the pivot point as well, which are great pullback opportunities. Such as here in the next pivot point. You can see after the breakout, the pivot point started to move higher, confirming the uptrend. The market pulled back into the pivot point, showing you the retest signal. You don't want to trade right at the pivot point. You want to see when the market is accelerating away from the pivot point. That shows you that there's bullish momentum in the market, and at that point, this is a much higher quality signal than trading when the market moves into such a pivot point with strong force. And then afterwards, you can see the pivot points continuously go higher during the uptrend. And then something changes again. Here you can first of all see that the pivot points are now much closer together. The closer the pivot points are, the more it signals a sideways range. When the pivot points are separated, it shows you a trending market. Then the pivot point is being retested from underneath as resistance, whereas previously the market was always trading above the pivot point and using them as support. This is a very important shift. The second important shift occurs when you get lower pivot points. This is a complete change of structure. The market is also now breaking previous lows, using them as resistance, and you can see the pivot points are now going downwards. So pivot points are a really great tool for trend following trading. They tell you a lot about the market structure. They can be used for pullback trading as well, and they're universally very versatile. The daily high-low is a very important concept, and although you can use it as an indicator, it is also a general price action concept, because what you're essentially doing is that you're going to your daily time frame, you're looking at the high of the daily candle, and you're looking at the low of the daily candle. And how the market trades into previous day's highs and lows is really important. In TradingView, when you search for daily high-low, this is what you get. You get the channel here, and this is the daily high-low indicator. It's completely available for free on TradingView. The green channel is showing the daily high on your chart, and the red channel is showing you the daily low. During a downtrend, what is very apparent is that the market breaks into daily lows, and a downtrend is continued when the market reaches a new daily low and trades outside of it. The market is also typically not reacting and not reaching a daily high in a downtrend. When the market in a downtrend moves into a daily high and then rejects it very quickly and is not able to break outside and close outside of a daily high, this can often be a great continuation signal, as we have seen here. The market is trading into the daily high, but is rejecting it very quickly and then continuing the downtrend. Here we can see the market is not able to continue the downtrend, and here we are entering an accumulation phase. After a long downtrend, when a consolidation goes on and on and on for a long time without continuing the trend, we don't call this a consolidation anymore, but we call it an accumulation. In the case of an uptrend and then a sideways phase, we would call this a distribution. And then what we see is the market is breaking into a new daily high and also able to close outside of the daily high, which is the first time in all of this trending period. And then you can see it shifts completely. We break out into the daily high, the market is able to trade outside of the daily high, then it pulls back a little bit. On the next day, you can see we get a breakout very early on. We're taking out the previous day high, and then it keeps going, and this is how the trend unfolds. And you can see the market stays very far away from the daily low, and this is typically then how bullish trends unfold. Here you can see the market try to break out. However, this momentum slowed down after the market broke out of the daily high, and then we have the acceleration back into the daily high-low channel. And here you can see the market is not able to trade outside of the daily low, and we have a quick rejection and then a fallback, and the market is able to take out the previous resistance and closing into the daily highs. So we have a momentum rejection into the daily low. We are in an uptrend, so this can be seen as a very great pullback continuation entry. And then you can see the market afterwards. This is where the rejection happened, kept trading higher, and the market continued the uptrend that it was on. When this changes and when the market is not able to trade into the daily high, but is able to stay around the daily low and able to stay outside of the daily low, you can see this is where the trend rolls over and we are following a new downtrend. So the daily high-low indicator or the daily high-low concept is a super useful tool. It is great for multi-time frame traders, and even if you are a day trader, this can really help you understand trends in a much better way. Next is the Bollinger Band spike, and I'm using a regular Bollinger Band, and if you open the settings on TradingView, I'm trading typically the 1 hour or the lower time frames, but when you open the Bollinger Band setting, what I do is I set the time frame to 4 hour. What this does is that it gives you the Bollinger Band channel from the higher time frame, but it shows it on the lower time frame. And this is how it looks. We're on the 1 hour time frame, but this is the Bollinger Band channel from the 4 hour. And what you will see is that during a strong trending market, the price is usually staying outside of the Bollinger Band. This is a very, very strong signal that you are in a trending market. When you see that the market is rejecting the lower bands, especially in the case of an uptrend where the market previously traded outside of the Bollinger Band, this can be a great rejection signal and often is used as a continuation signal to trade into the overall trend direction. You can see here we rejected the lows, the market continued to trade into the highs, but here we are seeing now weakness, whereas previously we have seen the market was able to trade and close outside and stay outside of the Bollinger Band. This is not the case here anymore. The market tried to break out, but was rejected and the price fell back inside of the Bollinger Band very quickly. When you see those quick rejections, they show weakness, they don't show strength anymore. Of course, there's still a chance that the market could close above the high. In that case, we would look for continuations, but if the market is taking out the low of such a wick, then very often it's a signal of a move into the wick direction, so in this case downwards. As it happened here, the market rejected the highs, we closed and took out the wicks. The market moved into the opposite Bollinger Band and then was able to stay at the opposite band and also trade outside of it. Very different picture from the rejections that we have seen previously. And the Keltner Channel, finally, it's also one of my favorite indicators and favorite tools. It uses the concept of the ATR, the average true range. And although the Keltner Channel is kind of an indicator, it uses price action concepts because the Keltner Channel uses ATR, so it looks at how much has the price trended and moved yesterday, the day before that, and it then shows you the average of the trending moves that happened in the past, and it plots them on your charts. When you open the Keltner Channel in TradingView, this is my setting. What I do is I use the default length 20 multiplier 2, but the only thing I do is I change the time frame to the daily. So I want to see the daily Keltner Channel, but on my lower time frames. And this is what it looks like. We are on the 1 hour, and this is the daily Keltner Channel that you are seeing. What you are often, not always, but what you're often seeing is that when the market is in a trending mode and reaches the Keltner channel, it is not able to often trade outside and keep going outside of the Keltner channel for an extended period of time. Why is that the case? Just think about what the ATR does. The ATR looks at the last 14 or 10 days of your price action on a daily time frame, and then it analyzes and sees how long and how big are the candles on the daily time frame, and then it gives you an average, and this average then is used in the future. And what we do is then we expect that today's price action is going to be relatively similar to the price action that we have seen in the last 14 or 10 days, depending on which setting you're using. And this is such a great and important concept, and you can use it across all the markets. Here you can see the market reverses at the lower Keltner channel, and it trades all the way back to the higher Keltner channel. And Keltner channels can therefore be greatly used as target tools. So when you are using a trend following approach, if you're looking for a target approach, Keltner channels can be a really great addition to your trading. Another great way of using the Keltner channels is looking at fakeouts and exhaustions around the Keltner channels. So here you can see the market trended into the Keltner channel. It gave you a double top, a resistance breakout, and which is then a fake out when the market reverses. I've talked at length about those strong reversals. The stronger such a rejection at a daily high or low or at a previous resistance area, typically the stronger the signal is. And here we are trading all the way at the outer side of the Keltner channel. This is an extreme level, and it makes continuations outside of the Keltner channel not as likely as maybe a move into the opposite direction. And this then happened here. We have the breakout, we have the liquidity run. If you've been watching my videos in the past, you know what a liquidity run is. Here you can see then the strong selling return, and the market moves all the way back into the Keltner channel on the opposite side. Here then you can see after the market from the stop, a liquidity run arrives at the opposite side of the Keltner channel. The price tried to break out of the Keltner channel, but it didn't succeed. The market shot back up. Then you can see we make a high. We have another attempt. The market fails to reach the lows. And then you can see on the breakout out of this inverse head and shoulder, the market started to rally higher. So observing the price action around the Keltner channels, especially if you're using the daily Keltner channel, can be a great addition to your trading because it can help you improve your target approach, but also looking at trend continuations or trend reversals can really make a difference using the Keltner channel.